Let's make better sense of this news. We have Mr. Probal Sen, the VP of Equity Research at ICICI Securities, joining us on the show. Probal, hi, good afternoon. Thanks for your time. My colleague Ashesha was just flagging off that now that this excise duty has been slashed by about 10 rupees per litre on petrol, OMCs stand at least breaking even, if not making a profit. What is your take on this? How does this financially affect OMCs? And do you believe that they're actually at the cusp of breaking even, or are there other headwinds that are at play?
So first of all, as far as retail margins are concerned, our calculations suggest a slightly different number. As per our calculation, I think there are still significant losses that are still being made on retail prices, specifically on diesel and petrol. Diesel prices, just to give you an idea, which were basically in the range of, I think, around 90, when crude was at about 71 to $73. This was the pre-conflict level. The absolute price of diesel has now become $188 to $195, right? So that is a more than doubling of effective retail product prices in the Asian markets. So this 10 rupee excise decrease, yes, it takes care of somewhere in the range of around $20 of increase, but there is still some significant amount of losses that are still there in the system. What this does essentially is to spread the loss between OMCs and the government. So the government is obviously absorbing a big portion of the loss that was being incurred. So that is encouraging. But I would believe that further price moderation in international prices and or retail price increases in the Indian market would be needed to sort of mitigate the entire losses and get OMCs back to profitable area, at least on the retail marketing side.
Okay. And Probal, in terms of a quantifiable impact, what would that kind of a number be? What are you penciling in terms of the number? How much of it will get absorbed as a result of this excise cut?
As I said, our estimates of blended retail margins for petrol and diesel was well over 30 rupees a litre at its peak in the last week or so. Now, please remember that there are a couple of assumptions that need to be made here in the absence of enough information. The Indian basket of crude that you would generally use as a benchmark for crude costs, because at the end of the day, retail margins you calculate by what is your effective crude cost. On top of that, what is your product spread? And then that is the RTP at which this would be transferred to the marketing division. And then you calculate the taxes and so on to get to your margins that you're making. Now, the Indian basket of crude itself has become an unreliable marker because no crude is really flowing from Dubai or Oman, which is 70% weightage in your Indian basket calculations. So all of us are having to rely a little bit on our judgment and channel checks in terms of what the actual crude cost is with respect to, let's say, a Brent plus whatever benchmark, whatever number you want to sort of plug in. So to that extent, our sense is that blended losses are probably still in the range of another, still 20-25 rupees per litre or so. And therefore, that's why I mentioned that this essentially only serves to reduce the impact to a certain extent. It does not mitigate the loss completely at this point of time.
Probal, talk to us about how much of a price increase would probably mitigate that loss entirely at the pump. What would that price increase look like?
I don't want to speculate because there could be other changes as far as taxes is concerned. There could be other changes on the international product prices, which are on unnatural levels. As I mentioned, diesel spreads, if you calculate with respect to, let's say, even the Indian basket of crude, I mean, diesel spreads are at $40 plus. These are not numbers on which you make any calculations. And similarly, ATF is at an even higher level. So on a day-to-day basis, as I said, you would probably still require a significant amount of price increase, 10-15 rupees plus, or even if I were to average out what has happened over March. But the point is that one would have to look at normalization of these numbers to a certain extent before even the OMCs would take any drastic decisions on price rise. That is my sense, and I think that is what the government is trying to do. It's trying to mitigate the loss to the extent that it can, so that no sudden shocks to the system are given from a pricing perspective for the Indian customer. So I think we're going to probably have a status quo for some time more, as and hopefully the conflict will sort of resolve, or at least some solution can be seen over the next 15 to 20 days.
And on that note, Probal, when you talk about resolution or, it's anybody's guess where this conflict is headed, does this excise duty cut in any way impact or affect or make any change to the sensitivity that OMCs have in terms of how their margins stand to be affected with every dollar hike that we're seeing in crude prices? Do these two have any interrelation between them?
Yes, that's a very good question. Typically, every dollar increase in product prices tends to have an impact of anywhere between 53 to 55 paisa per liter on the final price, or that's the kind of pricing change that's typically needed to keep margins at the similar levels. With the excise cut change, I think your impact could be reduced by maybe about a few paisa, about 10% or so. So the actual price change required for every dollar change could be maybe 45, 46 paisa or so. It's difficult to do an exact calculation, but that's the rough idea that I'm trying to give you.
What's happening with regard to GRMs? If you have give us some color on that, because there is one section of the market which seems to believe that GRMs will actually be a great way to play crude at this point, given that they are elevated in some fashion, and therefore maybe some pure play players in that space, NMRPL or Chennai Petro, may actually benefit.
Yes, I think if no changes are made in the way RTP is being calculated right now, as I just mentioned, product spreads are trading at extremely high levels. Even if you factor in the crude costs or the Indian basket of crude, even on those prices, diesel and ATF spreads, which are more than 50 to 55% of product slate of the independent refiners, those are obviously trading at extremely strong levels. So, if there is no other regulatory change or there's no change to the way RTP is calculated by the OMCs right now, I mean, they could actually see supernormal profits for a short period of time. Absolutely.
Well, it's been a really good conversation. Thanks for quantifying this impact for us to whatever extent you have. It's very helpful and gives us a deduction to try and understand what's happening with OMCs now that this excise duty cut is at play, and with the backdrop of everything that's happening with crude prices geopolitically. Thanks so much for your time today.
Thanks for having me.
Okay.